Hi, everybody. Welcome to our second lecture. I want to go ahead and quickly look to Canvas just to once again make sure we're clear where the different information is going to be located. You can see chapter 1. You can see the chapter 1 lecture. Today, we're going to go through chapter 11. And obviously, if you're watching this video, you saw that the lecture video was here as well. So you have your lecture videos, you have the slides, you have the practice midterm, and we're going to do that for chapter 11 today. Okay, so let me go ahead and get that chapter 11 material back up and put my machine in slideshow mode. Okay, and when you take a look at chapter 11, you're thinking, well, geez, we're jumping quite a bit ahead. But really what we're looking at are standards today. And we're going to look at standards both from the standpoint of accounting standards, but we're also going to understand a little bit about what some of the auditing standards are, in particular as they relate to fraud, and then what some of the standards are that are, and laws, frankly, that are applicable to public companies through the Security Exchange Commission and also something called the Sarbanes-Oxley Act. I'm also going to point out to you that the Association of Certified Fraud Examiners has a handbook that if an individual were doing an investigation of fraud, it would be a very useful resource to understand different procedures, different fraud schemes, different procedures, very much in line with how we'll look at some of the materials we move along through the text. So I thought it was a good idea to go ahead, even though the text chose to put this information a little later in the book, I think it's better for us to go ahead and talk about it here in the early going. So when we start to talk about fraud, we started talking last time about the fraud triangle. We talked about incentive and pressure. We talked about opportunity. We talked about rationalization. Now, opportunity, we'll talk a little bit about internal control because management does have some responsibility for maintaining an internal control. But let's right here talk about the incentive and pressure side of things and then the rationalization. So I think when you think of individuals committing fraud, you think of somebody who's born as a criminal of some sort, or as an organized criminal, or has committed themselves to a life of crime. And we're going to see that that is actually accounts for a smaller amount of fraud than those associated with fraud schemes coming from senior management and mid and lower level employees. So let's think about that. Senior management. Let's think about founders of companies and whatnot. We tend to think of individuals that are high level thinkers or great individuals that start these businesses and stuff and are very successful, and that's all true. So how does it end up that they are engaged more in the commissions of fraud and what we called last time larceny, theft, that sort of thing, than more than is the case otherwise? And probably, and I'm not a psychologist, but I'm thinking probably what happens is they're sitting there, they have good intent, and then what happens? This incentive and pressure starts to come, okay? And it's a daily grind of incentive and pressure, until, and let's just think about the pressure part of it, it gets so overwhelming that they become desperate, okay? And they start thinking, wow, how am I gonna get through this? How am I gonna get past that? And then the rationalization comes in. Well, if I don't do this, then this will happen, and maybe that's not as fair for the rest of the individuals, and they start to rationalize the reasons that they should go ahead and engage in fraud. Think of it this way. Let's say you have a big assignment due for school, for your class or something, and you're sitting there and you're thinking, well, gee, I really am gonna turn this assignment in late, or I'm not going to get a good grade if I don't. And you might start to do what? You might start to fudge the rules a little bit about how you're going about getting information and whatnot. And you might rationalize that by saying, well, other people are doing that, or if I don't do this, my paper is going to look worse than the other person's, or I have no choice but to do this, and I'm only going to do this one time, and in the future I'll always make sure I follow all the rules and stuff, right? So this is how this kind of thing starts to build. It's not like someone sits there and says, let me come up with a fraud scheme. They're faced with what? They're faced with certain circumstances, and as a result, okay, the psychology as well as you move along through that continuum that I just described. Okay, so we're going to see that senior management, mid and lower level employees, which we have regarded as occupational fraud, remember last time, tend to be a little more prevalent than you might think. Organized criminals who maybe have just dedicated themselves to a life involved with violating the law. Now we come over. And why do people commit fraud? To make the business performance look different than actual. Maybe wanting it to look better is what we tend to think of, higher revenue, higher income. But maybe we're having a particularly good year, and so we want to make our performance not look as good this year so that the later years look a little better. We might shift revenue from the current year because we feel we've made enough to try and throw it into the next year. Or maybe we're trying to devalue the company because we're going through some sort of process that if the company's valued more, we're going to have to share a larger share of the business with somebody, whatever. Okay. To preserve personal status, right? Nobody wants to be part of a failing entity. And also to maintain personal income wealth. I need my company to look better so that I can get to a larger percentage, revenue percentage, whatever. Maybe there's some sort of incentive, right? Incentive and pressure package. So all of these reasons would probably fit under the incentive and pressure broader category that we talked about last time in the fraud triangle. Now, when we are talking about performance overstate, and we're going to look in a minute why you might understate business performance. Overstating what? Making our revenues look larger, making our net income look larger. And let's just go ahead and take a look at a couple of the potential reasons that we might want to overstate things. So obviously, to exceed or meet expectations regarding revenue growth, regarding income growth. Analysts like to look and see operating income, revenues increasing steadily year over year. And if all of a sudden we have this drop, we don't think that's going to look too good, or we also don't want this wild swinging sort of up and down. So we want to have a nice smooth profit line. So the entity might engage in some sort of financial reporting fraud to make that profit growth, revenue growth look nice and smooth. Okay. To comply with loan covenants, what happens here? Often to the protection of creditors, okay, loan lenders, bondholders, and whatnot, there'll be a covenant that will be put in the contract that will say, if the debt to equity ratio falls below a certain level, then or rises to a certain level, then we're going to call the debt immediately. Now, if you're the entity and you know that you don't have the funds to pay off that debt immediately, and now you're not having certain performance ratios to where they should be, then you might engage in financial reporting fraud to protect yourself against that. Okay. To meet a lender's criteria for granting, extending credit, okay, to meet corporate performance criteria set by a parent company if we're a subsidiary. So I think you get the sense that these pressures are coming in. The entity wants to overstate revenues, wants to overstate income, maybe understate expenses in order to make the company's performance look better, right? Now, you can look that we're talking about from the company-wide level, but I mentioned sometimes maybe we have a bonus that's going to be associated with a good performance for the company. Maybe we're sitting there and we hold some stock in the company and we're thinking of selling that stock. So we want the performance to look good so that the stock value isn't impacted negatively by a poor performance. Okay. Now, understate, right? And we tend to think, well, why would someone want to make the business look worse? Well, perhaps we have a nice earnings stream this year. Our income is looking good, and we're thinking, gee, maybe next year isn't going to be as good. So let's go ahead and we're going to talk about the idea of proper matching here in a little while. But what we're going to say is, well, rather than take the revenue this year, let's try to kick it into next year so we get a head start on next year. Or maybe we'll go ahead and when we deal with estimates, right? For example, the allowance for loan loss. Allowance for loan loss is based on an estimate, and we were sitting there and saying, well, we could probably fudge this estimate a little bit more to take more bad debt expense this year so that we don't have to take as much next year because this year's income is already looking pretty good. All of these things might be ways that you could do that. Sort of, you can see taking the big bath now, maybe writing things off now, taking more bad debt expense now. And we can do that now because maybe our income is looking a little better. And again, we're always looking for that smoothing of our profits. Okay, so we're trying to conserve the trend, consistent growth. We don't want that volatility. So we can smooth profits more by doing something like putting more in the allowance now, and then later we go, oh, our allowance is sufficient. We don't have to take as much, right? Okay. Maybe, we're going to have some sort of settlement that's coming. And if we value the business less, that'll be more advantageous for us at the current time. Maybe they were trying to plan a buyout or something. So all of these are reasons. And again, I've said a couple times now, it fits under this idea of what incentive and pressure. You can kind of see the different incentive and pressures that might go on here. So when we are engaging in financial statement fraud, and we're not going to do that, but when an entity is engaging in financial reporting fraud, they can do things like manipulate the accounting system or even go outside the accounting system to allow them to, show a probably better financial reporting performance, but as we've seen, it could be worse that they're trying to do now. So it looks better compared to other times, but give a fraudulent financial reporting, lying on the financial statements. Okay. Now it's important that we understand the financial statements. So we have the balance sheet, the income statement, statement of stockholders' equity, statement of cash flows, and then the related notes. Now, when an entity prepares those statements, as you know, they follow generally accepted accounting principles, and all entities are to follow the same set of principles, really, so that there is reliability in those financial reports and comparability in those financial reports, so we can make various investment and credit decisions. Now, it is worth understanding who the regulatory entities that set the accounting standards, and let me start here, second on this slide with the Securities Exchange Commission, the SEC. The Securities Exchange Commission was created in 1933-34 security laws, just after this crash of the stock market, the start of the Great Depression. There was some belief that companies were making up a lot of the information in their financial reports, and that had a lot to do with what happened with the stock market and what brought in the economic calamity that, frankly, there's almost no one left that was alive at that time. And even if they were alive at that time, they were little kids, right? So anyone who remembers the Depression as an adult is no longer with us, right? But it is so bad that it's in our minds as to, how terrible it was. And we have a lot of regulatory requirements that leverage off of that, frankly, that trauma that the country went through back in a time when really nobody remembers the trauma, at least as an adult, right? Okay, so 1933-34 security laws, they create the Securities Exchange Commission, the SEC, and they give the SEC the authority to set the accounting standards. But the SEC immediately turned to the accounting profession and said, we would like you to set the standards, and we're going to regulate and watch the profession as they set the accounting standards. And if you're not doing such a good job, we might have to step in. So first, they turned to the American Institute of Certified Public Accountants, the AICPA, and said, you can set the standards. The AICPA created two predecessors to the current standard setter, which you can see is the FASB, the Financial Accounting Standards Board. But the two predecessors to the FASB were the Committee on Accounting Procedure. They were established in 1939. And then we had the Accounting Principles Board, and they were established around 1959, I think it was. And the only reason I mention that is sometimes you'll hear a discussion of APBO, that's Accounting Principles Board opinion. And some of those are still in effect because the FASB didn't just crush everything that happened before and start all over. They adopted many of the standards that were in existence at the time that they came into existence in 1970. The FASB was established, and now the FASB sets the accounting standards under the watchful eye of the Securities Exchange Commission. And when entities prepare those financial statements, as we saw in the previous slide, they are to follow generally accepted accounting principles. Now, we really won't be focusing too much on international things in this class, but it's worth noting that many countries use the International Financial Reporting Standards, otherwise known as IFRS. The United States was thinking about adopting IFRS in the early 2000s, but the business industry really wasn't prepared for that. And so finally, the U.S. moved away, and the U.S. still follows their own sovereign standards promulgated by the Financial Accounting Standards Board. Some countries adopt IFRS. Usually it's emerging economies. So if you were to look at the United Arab Emirates, for example, they have a big stock exchange in Dubai. Well, if you list on that stock exchange, you follow IFRS, International Financial Reporting Standards, promulgated by the International Accounting Standards Board. And I wrote in IFRS there, you can see it's the International Financial Reporting Standards. It's also up here, okay? And they say over 100 countries. To be honest, the bigger economies tend to use their sovereign standards. China, US use their own sovereign standards when they establish accounting standards, okay? Now, the FASB has a conceptual framework, and we're going to be talking about some of that conceptual framework. And one of the first things that FASB did in putting together its conceptual framework, and of course it's been revised over the years, but at the time when they first established that conceptual framework soon after their birth, like 75, 76, they said, companies, you are preparing financial statements for external users. That is the objective. That's who we're thinking about when we issue a new standard. So we're talking about those outside of the company, and we have a lot of different users outside the company, but the primary ones that we're thinking about, our primary users are investors and creditors. So the SEC looks at that and they're like, yeah, that's good, because SEC was created to protect the investing public. FASB, when you write a standard and you decide whether or not to require a company to put something in their financial statements, these are the primary people you're thinking about, those outside the company making investment and credit decisions, okay? Now, when we take a look, you can see that when they're making these external users are making the decision, they're talking about loan approval, they're talking about, should I buy the stock? Different operational, financial decisions. All of these things are decisions that come off of the information that's contained in the financial statements that we've been talking about. And of course, we have what? We have the accounting system here that is designed to help us to generate these financial statements. And we're going to be talking about and you can see these different users. By the way, government, okay, vendors, probably government, they're outside the entity, they're external, but they're not primary. Our primaries are investors and creditors, like banks, investors, vendors are creditors to a certain extent, right? Management is considered internal, though obviously management uses the financial reports, but FASB not thinking about management. Management's already in the company, so they can do anything they want to analyze these transactions and take that information and use that. But what are we going to make companies provide externally that is going to be useful to the investors and creditors in making these different decisions? That's how they decide what goes into these different financial statements. Okay. Now you come over, and when the FASB is considering the users, their main constituencies, but they also have to consider other constituents. So they can't just ignore the needs of the preparers of the financial statements, for example. They have to think about auditors, right? Can we put so much burden on auditors where we require information that isn't audible, okay? Because eventually the auditors are going to have to give an opinion on those financial statements, and we'll talk about that a little bit more. You know, academicians, teachers, you know, you can't make the accounting standards so complex that I can't teach it to you. Okay, so all of these things come in, and the FASB has to weigh all that. So it is a political process. Okay, now is that a good or a bad thing? Well, you know, depends on how you look at it. Hey, you know, we should be doing what is in line with the conceptual framework, and that's it. Okay, but well, what happens if the conceptual framework gets us to, we're too far out in front of where anybody wants to go? Maybe sometimes you got to pull the reins back on that a little bit, and you know, let you think about that on your own, okay, as to whether this is a good thing, that it is somewhat of a political process. Okay, so let's talk a little bit about recognition and measurement principles here, okay? And you start to take a look, okay, and principle historical costs. Certain assets, liabilities are to be carried at historical costs. What did we pay for it at the time that we acquired, say, an asset? So we bought a piece of land, okay, I'm here in California, the Bay Area. We bought a piece of land in the Bay Area in 1970 for, you know, $100,000, say, you know, say an acre of land. Well, that same piece of land now could easily be worth, depending on where, a couple $1 million, right? Okay, so what happens if you were to pick up the financial reports of the company and you see that land account, it would show 100,000, what they paid for it at the time that they bought it. Why? Because we're trying to eliminate subjectivity when it comes to how we value certain things on the financial statements, and land is highly subjective. There's no bell that rings and everybody agrees as to the price of land. There could be some negotiation back and forth, et cetera. It has to depend on what's happening with the market at any point in time. And so for fixed assets like property, plant, and equipment, FASB says use historical cost. Okay, now you may say, well, that creates a distortion in financial reports. And you're right. In fact, under international standards, and again, we're not going to talk a lot about international standards, entities are allowed to write up, under the IFRS standards, they are allowed to write up their fixed assets above historical costs. So, okay, there is some argument back and forth, but in the US, remember that depression mindset is there, right? For certain assets where there's subjectivities to the value, FASB just says use historical cost. Now, if you were to look at a asset like an investment, I bought stock in a company and I'm reporting that as an asset and investment. Everybody agrees, if it's a listed stock, as to the price of that stock. At the end of the day, the stock bell rings, right, in the stock market, and everybody says that's the price of Apple stock, whatever it is. And so if you're holding an asset like that, then you could carry that at fair value. So even though we're calling out historical cost here, there are some assets, and it depends. If it's a financial asset, then they tell us you can go ahead and you can carry that at fair value. So both of those are, you know, considered correct measurements. Okay, here we're talking about measurement. Okay, correct measurements but it really depends on what we're talking about. Okay. Now, when we talk about revenue recognition, okay, revenue recognition is a big deal. And by the way, even though the U.S. did not go over to international financial reporting standards, they have worked together in some cases with the Financial Accounting Standards Board and the International Accounting Standards Board have gotten together, and they now have a joint conceptual framework, and they both work off that same conceptual framework. Now, there are differences, but there are times where they issue a joint standard. In the area of revenue recognition, they did that a few years back. Okay, so revenue recognition is important because what it drives the calculation of net income to a large extent. And of course, our net income is going to be reported as we have income year over year. It's going to add to the retained earnings. Retained earnings is part of stockholders' equity. So the company is going to be valued higher. The more income you have, the higher the stock, the more potential that if that income number is overstated, investors are going to be harmed, which is what we don't want. So revenue recognition is very important. And when we look at revenue recognition, the standard gets into, well, are we going to recognize it as a point in time? Are we going to recognize it ratably over a period of time? Are we indeed the entity that is providing the service that's being received? So should we take a gross revenue or net after we've paid an agent that has done a certain amount of work? There's all kinds of different revenue recognition, but it's very important. And it's important that as those that are looking for potential fraudulent financial reporting and the desire to over or understate, that we understand the importance of those revenue recognition. Are they trying to throw revenue into the next period? Are they trying to make this period's revenue look a little bigger? All of those things need to be considered. We saw some of the reasons, okay? So matching becomes important, not only the recognition, but as to whether or not it should even appear. So maybe I can clarify that a little better. Whether or not it should even appear on the financial statements, that's recognition. Matching is what period do you report that, okay? And so we want to not only make sure that we have recorded the revenue in the once it has actually been earned, right? But also do we report it in the right period? And that's the matching principle. Now, full disclosure, we saw the discussion of footnotes, and if you pick up any entity set of financial statements, you'll see pages and pages of footnotes. That makes the financial statements more understandable. If I just gave you the balance sheet, the income statement, and said, here, figure it out, that would not be meeting the idea of understandability, which is part of the FASB ISB conceptual framework. And so I have to provide you footnotes to make those statements more understandable. In other words, I have to have full disclosure of information you may need to make those statements more understandable. Okay. Now, constraints, cost benefit. What happens when FASB looks at a standard? Remember all those different constituents? The benefit to the users, okay, has to be more than the cost of providing that information. If the cost of the company providing that information is more than the benefit to the users, in the FASB can say, well, we're not going to require companies to provide that information. Materiality. Materiality means that the information has the potential to make a difference in the decision of investments and creditors. For example, if I had known that the financial statements were misstated by $25 million, I would have never bought that stock. Obviously, what? That large number is what's driving, hey, that's material, right? What if I tell you, if I had known that the financial statements were materially misstated by $25,000 because of financial reporting fraud engaged in by senior management, you might say, well, that dollar amount is not as much, but the qualitative aspect, the fact that senior management was involved in that is what makes it material. So it's not only qualitative, right? It's also quantitative. So we have both qualitative and quantitative concerns when it comes to materiality. I'm not a good speller or something. I'm just spelling that, but qualitative and quantitative, both. Okay. Let's talk about conservatism. Okay. Conservatism says that we should not take gains until the transaction is complete. However, losses we should take immediately. Okay. That's why we have to make an estimate, for example, as to our bad debt expense. So at the time that we make a sale, and by the time we get to, and we have credit sales, and by the time we get to the end of the year and we look to see what we've collected on our account receivable, we have to decide how much of that we're not going to collect. And you say, well, wait a minute, you know, that's not fair because it hasn't happened yet. Yeah, but under the rule of conservatism, we say, well, there's a good probability. It's more likely than not that it will happen. And so we need to take that loss. Now, we're under a lawsuit. We haven't come to determination yet as to whether or not we're going to lose the lawsuit. We would be required to determine if the loss is probable and then see if we can estimate an amount of loss, and we would take that potential loss immediately. All that falls under this rule of conservatism. Okay, gains. So you say, well, I think I'm going to win the lawsuit. No, you are not to recognize a contingent gain, because that doesn't fall under the idea of conservatism. Just keep in mind that idea of the Great Depression and companies overstating their value to the harm of investors to where it brought down the entire economy is a driving force. Okay. Now, relevance means that the information would be relevant to me making those investment and credit decisions. Reliability is the audit process. What makes the financial statements reliable is that an independent third-party auditor comes in and issues an opinion that says these financial statements can be relied upon. And we'll talk a little bit more about the role of auditors and all that, you know, all this in a couple of minutes. Okay. Comparability, I should be able to compare company to company. That's why it is important that all companies follow the generally accepted accounting principles, so I can compare them. Consistency says you really should be using the same accounting standards period to period. Okay, now it doesn't mean the companies can't change their accounting principles, but if they do, they have to have determined that it provides better, more useful information for investment and credit decisions, and they have to put some bright lines of disclosure around the fact that they have changed their accounting principles. And what we are required to do is see what would have happened. Let's say we start the business in, just to make up a year 2020. Okay, we start the business in 2020, and then in 2023 we decide to change from one accounting method to another. Okay, what would happen? We would have to go back and show what our financial statements would have looked like in 2020, 2021, 2022, all the years disclosed prior to the change, so that investors and creditors could see, okay, I understand you changed the accounting principles, but this is what the company would have looked like in those previous years had they followed that new standard. So as they're doing their trend analysis and whatnot, they can compare apples to apples. Then they make a cumulative effect adjustment to the beginning balance of the retained earnings of the previous period presented for the cumulative effect change of all of those different years. And they are required to do that so that investors and creditors can see, well, what would have things look like had they used that standard before? So this idea of consistency doesn't say you can't ever change the principle, but if you do, you're going to have to put some bright lines of disclosure along the lines of what I just spoke about as you're calculating things like cumulative effect adjustment, doing retrospective application to the different amounts that are in the financial reports, et cetera. Okay, now responsibility. Management is responsible for the financial statements. If you pick up an audit report, that's the first thing that auditor, well, not the first thing, it'll say, we have audited the financial statements, but then it's going to say, the auditor's report is going to say management fairly early on in that report. Management is responsible for financial statements. The auditor is responsible for expressing an opinion on the financial statements. What's an opinion? Opinion is a conclusion, a thought, a summary, if you look it up, right? So it's not saying, hey, I prepared the financial statements and you can trust me. It's saying, in my opinion, those people, management, prepared the financial statements in accordance with the generally accepted accounting principles. And when you see that, and sometimes my students will say, well, that's just a piece of paper. Well, that's sort of like, seeing a police officer and saying, well, that's just a piece of tin badge that you have there. Well, no, there's a lot that goes behind that, right? Okay, so when you see that opinion, that means that you can rely on that for investment and credit decisions. Okay, now we talk about management, but also there'll be a board of directors that should set a code of conduct that is telling us, hey, these are the ethical standards that should apply in the company, and they'll talk about different conflicts of interest and whatnot. If you walk into a company and you're engaged in trying to figure out some sort of issue with them, maybe it's accusations of fraud and whatnot, one of the first things you would ask for is, can I please see your ethics policy, your ethics statement, whatever it is, and code of conduct that is often called, okay, and see what is there, and start to evaluate the operations of the company against that code of conduct. Okay. Now, since management is responsible for the financial statements, and since we want to put into place internal controls that'll help prevent or detect misstatement in the financial statements, also protect assets, although we're not really talking about larceny so much here, as we're talking about what fraudulent financial reporting, lying, okay? But the entity should establish then a internal control structure. And probably the most commonly accepted internal control structure is depicted by this cube here that was put together some years back by the Committee of Sponsoring Organizations of the Treadway Commission. Treadway was the chair way back when this all first started, and they called themselves the Committee of Sponsoring Organizations. And they come up with guidance as to how a company should structure their internal control. And what Treadway, what COSO did at that point in time, okay, is they said, well, companies have a lot of objectives. Okay, they have what? They have operating objectives, compliance objectives, reporting objectives. Now, maybe we're talking a little bit more about the reporting, but also, hey, compliance is pretty important as well, because we could be asked to see if there's some sort of violation of law if we're doing some sort of, fraud investigation or some sort of forensic investigation. So what they say is across the entity, okay, there should be a control environment. Now, that stuff that we're talking about, senior management, the board of directors, that's the control environment, okay? And then what? That sets the tone, those ethical standards and whatnot. That then pushes down to the entity being able to assess what are our risks to achieving these objectives. Financial reporting, we want reliability in financial reporting. Are there things going on in the industry? Are there things going on in the economy, in society, in the changes, say, in accounting standards that are going to affect our ability to provide reliability in financial reporting? Then what? They look to see what control activities they have in place that will help them to achieve the reliability in financial reporting, focusing on that objective. The financial reporting objective are the control activities in place that will help meet that. If not, what do? They'll make changes to those control activities to help prevent, detect the bad outcome of the objectives, right? The negative, not having reliability in financial reporting. They'll put in controls in place to stop that from happening. And then they go ahead and they communicate to their employees, right? That's why we're asking for what are the policies, what are the procedures and whatnot, prevent or detect that. And we're going to want to see now, hey, are the employees following this? Are they being informed? Are they following that? Is it being communicated properly? And then we would look for some sort of monitoring in the company. Many companies use internal auditors to look to see that the control activities are meeting the various objectives. If they find some issues, they do what? They report that back. And internal auditors almost always report directly to the board of directors. In fact, if they weren't reporting directly to the board of directors, I would think that that would be a weakness in this control structure. That reporting from the internal auditors should come back to the board of directors control environment, and that process starts over again. What are the risks? How do we address it through the activities? How do we communicate the new controls now? And so on. So this could be a circle as well as a cube, but I think they want to do cube. So you can see how it could have different objectives and cut across different levels of the company. Okay. All right, good. Now, Sarbanes-Oxley Act. I'm sure you've heard of this. Okay. This was passed in 2002. Okay. Sometimes it's called the Sarbanes-Oxley Act of 2002. It was passed by Congress after certain financial scandals, Enron, WorldCom, Enron and WorldCom probably. Enron was a little more sophisticated scheme, so there wasn't an immediate reaction to that. WorldCom was not a very sophisticated scheme. Everyone could understand that. And so that really was a big part of pushing through what Congress decided to do in 2002 under the Sarbanes-Oxley Act. Sarbanes was a Democrat in the Senate. Oxley was a Republican in the House, and they worked together to get this passed in 2002. And so because it was coming off of scandal, what they wanted to do was go ahead and establish higher standards for corporate governance and accountability. There's fraudulent financial reporting schemes. Okay, just to maybe back up a little bit. You know, Enron was doing things like acting like they were having sales when they were not, revenue when they were not. They're acting like there were independent entities out there that were buying services when in fact they controlled those entities. WorldCom was putting things down as assets on the balance sheet that should have been expensed and lowering their net income. Okay, so these kinds of fraudulent financial reporting schemes, Congress stepped in and established the Sarbanes-Oxley Act. And so what it did was establish standards for corporate governance accountability. It also created something called the Public Company Accounting Oversight Board, which would be responsible for overseeing auditors, really, that go in and look at public companies. And why they start picking on the auditors? There was a CPA firm at that time named Arthur Andersen. They really fell apart as a result of all this to a large extent. There's some remnants that are still around, but to a large extent, what was one of the big accounting firms, Arthur Andersen, went away because of all this. And so one of the things they did was they created this PCAOB, Public Company Accounting Oversight Board, that we'll talk about here in a couple of minutes. And they were there to, they're there to kind of oversee the auditors, make sure they're doing the audits correctly, public companies. Develop severe civil and criminal penalties, civil and criminal. Civil means that you're going to potentially, have to pay a fine for things you do wrong. Okay, criminal means what? Criminal means, hey, if you do some of this stuff that was happening before Sarbanes, you're going to jail. They're pretty severe. Also, one of the things that was coming out of the Enron situation was there was an individual inside the company that kept saying there's a problem here, and they kept sort of retaliating against that person and pushing them down. Get away from me, you bother me, kind of thing. And so it created certain protections for whistleblowers. So we're going to continue to take a look at some of the details under this here as we go through and talk about Sarbanes-Oxley now. Very important legislation. Okay, so let's go ahead and take a look at some of the specifics, type of potential penalties that Sarbanes-Oxley put into place. And looks like my clickers decided to stop working for me. Let's see if we can get that going again. Okay, I'm going to be a little hampered, guys, so be patient with me as I try to advance the slides. Okay. Now, let me pause the recording, guys. I'm going to work this out. I'll be right back. Okay, and we're back. So let's take a look at some of the rules, and we talk about SEC rules. What the Sarbanes-Oxley Act did is say, okay, Security Exchange Commission, you are the federal entity that is responsible for ensuring there's protection for investors and creditors. So they put the enforcement of this federal statute, the Sarbanes-Oxley Act, under the SEC. And one of the requirements is that management has to provide a report on their internal control. So it is specifically required that in the annual report, management do an assessment of the internal control, talk about whether or not they've identified weaknesses and whatnot. And also under Sarbanes-Oxley, under Section 404, the auditors are to come behind management, and they are also to look to see that management has done a good job in assessing their internal control and point out any weaknesses that they have identified. We're trying to get rid of improper conduct, influence on conduct of audits. So management shouldn't be pressuring the auditors. And we're going to see that there's certain rotation requirements and whatnot for auditors. Also, the Public Company Accounting Oversight Board will set out standards for auditors, but there will also be requirements for attorneys, okay? Issues related to the company's audit committees, strengthening the SEC's requirements regarding auditor independence. And we're going to see, as I've mentioned, some requirements around disclosure, around rotation of auditors, and disclosure if there's any sort of off-balance sheet transactions obligations. So the Sarbanes-Oxley Act trying to address some of the issues that were identified in some of those financial scandal shenanigans that were going on at that time. You can see that there needs to be a financial expert on the board of directors, retention of records. There were issues where the auditors were shredding certain documents and whatnot. So they started instituting certain criminal penalties for, getting rid of records. Now, again, Sarbanes-Oxley created the Public Company Accounting Oversight Board, the PCAOB. And basically what the PCAOB does is they have the authority to set the auditing standards for public companies, and then they have oversight as to those public companies to ensure that they are following the standards as they conduct those audits. And so the PCAOB needs to require that auditors of public companies register with them. As I've mentioned, they will go ahead and develop certain standards for independence, how to actually conduct the audits. And then if you are an entity that audits public entities, you have to register with the PCAOB. And then depending on how frequent or the number of audits you do, the PCAOB will literally come in and check over your audit, see that the CPA firm has a good quality control system in place, and actually pull a sample of audits and take a look to see that they follow standards. So really trying to strengthen the reliability of financial reporting for public companies, and then putting some pretty tough requirements on the auditors themselves. Okay, so they will be looking if a public accounting firm has done something wrong, and there are cases already, some of them maybe that you've heard of, with disciplinary actions that have been taken. They are required to, the PCAOB establishes standards the entities are to follow when they conduct audits, and also they're supposed to have certain controls over the quality of the audits, and then they will be enforcing compliance with the Sarbanes-Oxley Act, and again, those professional standards, et cetera. Now, it's worth noting that the professional standards established by the PCAOB to a large extent point to standards that are established by the American Institute of Certified Public Accountants for non-public companies, and then PCAOB adds on top of that. So PCAOB, for example, is where you have to look to understand what the standards are for an audit of the internal control of a public company. If you're looking at an audit of internal control for a private company, you would, for example, turn to the AICPA standards. Some things like the assessments and whatnot that are made for fraud and whatnot are very, very similar to what is done under the private company standards established by the AICPA. The PCAOB requirements point to a large extent to some of those. And I'm going to show you a little bit about the fraud standards related to the AICPA here towards the end of our discussion today. Certification, criminal penalties, both criminal and civil. So they're going to get fined, and you could also land in jail. A person could also land in jail for fraudulent financial reporting. So, not good stuff to be involved in, and they're putting those on the high levels of the company, the CEOs, the CFOs, control environment. The idea is that that will push down to other employees in the company. The CEO, CFO will certify that they have reviewed that the report does not contain any misleading information, and it is correct in all material respects and whatnot. And if they violate these things, then you see some of those penalties that we saw on some of the previous pages. Also, they need to make certifications regarding the internal control, as I've mentioned, And if there are problems, they have disclosed that to the auditors, to the audit committee. And if there have been changes since their report, maybe they identified the weakness sometime back and now they've made the changes, but the reporting isn't coming out till a later date, you need to talk about what they've done to correct some of those problems and what some of the changes are that were made. So management has to do this annually in their annual report. If you pick up the annual report, the SEC requires, for example, that entities prepare a 10K report. The 10K is the annual report that they file with the Securities Exchange Commission. You should look for, you should see a report from the management about the internal control. You'll see that. You'll see the auditor's opinion, and you will see the auditor's attestation, the auditor's opinion as to the internal control as well. So focusing on that internal control and that is being properly maintained, and they're assessing the effectiveness of that and talking about any weaknesses and, of course, any corrections that they have made to those control problems. Now, standards for the audit committee, making sure that they are independent. So there needs to be a financial expert, and there should be a whistleblowing structure. I would think that you may think as a career goal someday as being perhaps the financial expert on a board of directors. CPAs, CFEs, and whatnot are sought after to fulfill some of those opportunities and fill some of those requirements for the independence of the audit committee. For the independent auditor, there are some services you cannot provide to your client while you're also auditing the financial statements. For example, bookkeeping services. And you look at that and you're like, okay, yeah, because what happens if I'm applying the bookkeeping services, providing the bookkeeping services, and then I'm turning around and I'm also trying to audit the financial statements, I'm auditing my own work. Since auditors are required to look at the internal control as part of the audit, then I can't provide outsourcing of the internal control because I would be auditing my own work. So any kind of service that could get you into a situation where you are ultimately going to be auditing your own work, Sarbanes came out and said no. Before Sarbanes-Oxley, it was okay for the auditors to provide this kind of service contemporaneously with the audit. No more. And that's been the case for some time now, since 2002. As I mentioned, mandatory audit partner rotation. So to maintain objectivity, the partner needs to rotate off of the audit every 5 years. Every 5 years, I have to hand the audit off to a second auditor, And then the auditor reports to the audit committee. And there are certain requirements as to what I need to report on. There were material communication between the auditors and management. Board of directors has to know everything. Everything goes up to the board of directors. So if you had some communication with management, you need to make sure that the board of directors and the audit committee know about that, okay? And then auditors attestations to the internal controls we've mentioned, and if there was any sort of improper influence with the auditors, all these things. Again, trying to strengthen the corporate governance structure was a major thrust behind Sarbanes after, again, some of those scandals that I've already mentioned. Whistleblowers, protection for whistleblowers, okay? And so if someone is trying to call out and say that there's some sort of problem with the company, and the company tries to suppress that and punish them, it opened up the opportunity for the whistleblowers to civilly sue the company. So it protects them even if the company ultimately found not to have committed securities fraud. If they went and were being pressured as part of their whistleblowing efforts, then the entity could be civilly liable for that. Okay. Enhanced penalties, okay, for different crimes, mail fraud, document destruction. Again, that was a big deal with the Enron case, etc. Okay, disgorgement of bonuses. Disgorgement means we're going to take the money from you that you got because of a certain performance that you were fraudulent about. We're going to actually make you give that money back. Okay, they call that ill-gotten gains, and you'd have to get that back. Okay, understanding the type of crimes: misappropriation of assets, stealing, right? Financial statement fraud, you can see down there as well. Okay. You can see the amounts associated with these different things, financial statement fraud being a large, median loss there, okay? And then by categories. Look, guys, there is rarely fraud in the, office supply account, okay? It tends to hover around revenue. Okay, and so that's why they require us to really take a good look at revenue. Are they overstating the revenue? Are they, having bad matching, reporting in the wrong period, et cetera? Okay, now we've mentioned standards, federal statutes, and whatnot. It's important to note that the American Association of Certified Fraud Examiners does have a fraud examiner's manual, okay? And when you take a look, and it's a pretty extensive document, okay? But when you take a look at the preface, okay, it tells us that the fraud examiner's manual contains primary body of knowledge, which the Certified Fraud Examiner, CFE, you become a member of the CFE, you pass their exam, you meet certain experience requirements, then you get to put CFE behind your name, okay, as a credential, and it's based and contains functions essential for the fraud professional, okay. The Fraud Examiner's Manual content is organized into main sections, and we will be studying a lot of those things. I think you've seen that seal on some of the slides that the textbook uses. And we will be looking at many of the guidance that is provided in the CFE manual. Now, the manual here that we saw here, okay, the Fraud Examiner's Manual, we will be taking a look at some of those standards as we go through the text. Okay, now what I want to do at this point is show you a couple of things. Okay, one is right here. Okay, because remember, we also mentioned the AICPA and the requirements for auditors, external auditors of companies, to look at considerations of fraud. Okay, so that's what we have here. And I just want to show you a couple things. They go through some of the things that we've talked about, for example, the characteristics of fraud, okay? But they start mentioning, okay, who is responsible, okay, and who's responsible for the prevention, detection of fraud. It is the management of the entity, right? The auditor is responsible for doing what? Conducting an audit in accordance with the generally accepted auditing standards. That's what's promulgated by, and it's for the non-public companies, it's the AICPA, and then for public companies, the PCAOB layers on top of that additional requirements. But notice the auditor is responsible for conducting the audit to provide reasonable assurance. You can never provide absolute assurance, reasonable assurance. We always leave room for doubt, right? Reasonable assurance that the financial statements are not material in the statement, whether caused by error, which is an accident, or what? Caused by fraud. So the auditors need to think about what is the potential for fraud and then respond accordingly to that. Okay, so what have we looked at? We've looked at standards from the general accepted accounting principles, right? We've looked at in how entities have to follow those. We know we have the SEC overlooking the FASB, but then the SEC is also involved, and Sarbanes-Oxley has strengthened much of that in the audits of public entities, creation of the Public Company Accounting Oversight Board, looking to see the companies are conducting those audits accordingly. Sarbanes basically making sure that entities know that they're going to be civilly and criminally liable for fraudulent financial reporting. And then we have auditors' responsibilities that are there and reporting to the board of directors. We have to have a financial expert on the board of directors, and we have standards that tell us, hey, yeah, we do have responsibilities relates to detecting fraud when we do our audit. Okay, all of this, guys, you know, I often tell my students is somewhat of a prayer. It's saying, please don't let the bad thing happen. What happens? Bad things continue to happen because there's always somebody trying to get outside of these requirements, right? And that's why we have a role as professionals to help prevent, detect, deter these things from happening, right? But they do continue to happen. And so all this stuff is in place to, you know, hopefully mitigate some of that, but also be ready to respond to it. And we've seen what the different, you know, outcomes, negative outcomes can be from individuals engaging in this sort of stuff. Okay, so that takes us pretty much through our discussion for chapter 11. But what I want to do at this point now, assuming I can find what I'm looking for, is look at our practice exam. Okay, so these questions that I'm putting in the practice exam, you will see questions very, very similar to this on your exams, on your actual exams, your midterms, and your final stuff. Okay. So let's just go ahead and take a look at this. Which of the following is a reason that a chief executive might commit financial statement fraud? To receive increase in performance bonus? Yeah, that's incentive, right? Remember, incentive and pressure are the high level things. To avoid termination? Yeah, that's pressure, right? Incentive, pressure. To conceal the company's true performance because of pressure or maybe incentive, right? And so all of the above of these would be considered, you know, potential reasons. You know, we're not saying this is a justifiable reason, but it's what could lead to engagement in fraudulent financial reporting. The financial statements of DRG Industry contain a misstatement that is so significant that the reasonable investor would likely make a difference in the investment decision if they were given the correct information. What concept? Materiality. And just remember, we are not limited to quantitative. I think we tend to think, well, what's the dollar amount? If the dollar amount is big enough, then it's material, but it's also qualitative as well. Okay. Number 3, a company's financial statements are the responsibility, we've seen, of management, right? Which of the following is not one of the provisions established under the Sarbanes-Oxley Act? And we have these different things, but you look at the right answer, creation of the Public Accounting Standards Board. No, it was what? Public Company Accounting Oversight Board, yes, but the what? Creation of the accounting standards fall under the Financial Accounting Standards Board, which was coming off of the 33, 34 Securities Acts, and then the creation of the profession setting the standards first under the auspice of the AICPA through the Committee on Accounting Procedures, and the Accounting Principles Board, and then the creation of the FASB in 73, like we talked about. Okay. Let's take a look at number 5. Which of the following is the duty of the Public Company Accounting Oversight Board? Registering accounting firms that audit public companies, yeah. Establishing or adopting standards, yes, they do, that are relevant to public companies. Sometimes they'll point to the AICPA standards and say, do what you're doing for non-public companies for public, but they add on the requirement to have that auditor's attestation as to the internal control was solidly under the bailiwick of the PCAOB and auditors of public companies, for example. C, enforcing compliance with professional standards and securities laws. Yeah, they'll even investigate public accounting firms and come in and look at some of their audits. So yeah, all of these, okay? The Sarbanes-Oxley Act placed restrictions as to the type of services the public accounting firms are allowed to perform of audit clients. We specifically called out what? Bookkeeping, okay? Tax services are still okay. An entity can still audit help prepare the entity's tax return and audit the financial statements. What they can't do is they can't audit the personal returns of individuals that are involved in the bookkeeping process. So I shouldn't say audit the tax return, but prepare the tax return. So if I'm auditing a big company, I can't also be the person that prepares the tax return for the CEO, CFO. That would be a violation of Sarbanes-Oxley requirements. Okay. Number 7, under the Sarbanes-Oxley Act, chief executive officers and chief financial officers are required to personally certify annually and quarterly SEC filings. Which of the following is an item that they must certify that they have disclosed to the audit committee? Again, that corporate governance objective that was set up there under Sarbanes is a very important thing. Okay, good. Now you come over number 8, in investigating registered public accounting firms and their employees. That falls under the bailiwick of the Public Company Accounting Oversight Board. Okay, a couple more questions dealing now with responsibilities of external auditors. Which of the following statements best describes an auditor's responsibility to detect errors and fraud? An auditor is to provide what? Reasonable assurance of detecting errors and fraud. Yeah, it was reasonable assurance, right? That's a key phrase there. We never are able to provide absolute assurance because there's always collusion, deception and whatnot that we may not be able to detect. So it's reasonable assurance where the financial statements are materially misstated, whether caused by error or fraud. You look at some of these others, guys, and come on. I mean, when they start putting in the phrases of no responsibility, you should, kind of be suspect of a particular question that's trying to tell you that an auditor has no responsibility. So A is obviously, and that was right out of what we saw in the guidance issued by the AICPA. Which of the following factors most likely would heighten the auditor's concern about the risk material misstatement? From misappropriation of assets, okay? The entity's fixed assets lack ownership identification. If you're not putting something on a fixed asset that shows that it belongs, and there's a, one of those little plates that gives you the asset's identification number and whatnot, that sounds like a control weakness to me. Remember, when we're looking at fraud, we're looking at incentive and pressure, we're looking at rationalization, but opportunity, that's a poor control. And I'm of the belief, personally, that poor control is the biggest cause that will lead somebody. Leave the door open. The human nature is somebody's going to try to take advantage of that. But let's look at these others. There's a potential for bias in the preparation of accounting estimates. Well, that might lead us to the line, the estimates to the financial reporting fraud, but the stealing, the misappropriation of assets, not so much, right? Okay, the situation that we talked about last time, right? The stealing is probably not going to be affected by accounting estimates. The entity recently experienced rapid growth in revenue. Again, that might lead to financial reporting fraud, but not so much from this for the stealing. Management recently adopted new accounting principles. So you look at B, C, and D, those are probably leading to financial reporting fraud. The misappropriation of assets, the stealing, that's probably going to be that's going to be more under the idea of the fixed assets lacking ownership identification. And then I went ahead and for the software I was using and get the right answer, they turned that green. Okay, guys, hopefully this is helpful. We're going to continue like this, putting up a lecture, putting the slides as we move through week to week through the course. Okay. All right. Thanks, guys. We'll see you soon.